Welcome to the Airmere Roundtable. Today is the 24th of September, and my guest is Tim Pierson, who's a special member of the Airmere community. He does mentoring with us, and now he's going to be running the Limited Risk Strategies Trade Alert Service. So welcome, Tim. Nice to have you here as a guest, as a presenter.
Good morning. I'm excited to be here and to be doing this.
Yeah, and before we get too far into it, just the normal disclosure that Airmere is not a broker-dealer or investment advisor. This is for educational purposes only. Options involve risk and aren't suitable for everyone. Past performance is not indicative of future results. And if you want to read the whole disclosure, go ahead and pause the video and have at it. So with that, I'm going to stop sharing my screen, and Tim, you can share yours.
Okay, well, don't know if I don't have any slides or anything, but
Oh, you don't? Okay.
we'll get Thinkorswim up here. I thought I would talk about me just a little bit and what I'm going to do in the service.
Okay.
Um, and thanks everybody for joining in. I hope you've been getting my messages. We opened a new trade on Friday on SO, which is Southern Corporation. They're an energy company, and so far so good on that one. I actually could bring up option view. Let's see here. But I wanted to talk for a minute about what I plan to do here since I'm, starting to run the service. So it's called Limited Risk Strategy Service, and covered calls are not necessarily really limited risk. If you just buy the stock and then sell the calls, that's a covered call, but you have the investment of buying the stock. And if it's a $75 stock, let's say that's $7,500 just to buy the stock, and then you sell the call and you get a little bit of premium for that. Well, what Dan was doing, and I plan to continue doing, is what we call synthetic covered calls. Still trying to get option B going here, where we don't buy the stock, we buy a deep in the money call that's further out in time than the one we're selling, and that costs, if the stock was a $75 stock, that deep in the money call at about 80 deltas where we buy it might be $30 or something. So the investment is cut in half or more. It's greatly reduced by doing that. And then to further limit the risk to the downside, Dan's been buying some long puts or something to hedge the position. And that's a good idea, but we're giving back some of our potential profit in doing that. And so I want to limit the risk, but I'm not necessarily going to buy puts all the time to do it. Now, let me bring up SO, for example, if I can. Okay, I have to add a over here. Okay, here we are. Now, in this case, we bought the long covered call out here for $4.28. It's at the 40 strike. It was about 4 points in the money, which is a lot for SO. It's 10% move. And we sold the 44 call here for 78 cents. If you look at the graph, it looks like this. And I need to change my date here. There we go. It looks like this. And if you look to the downside, the maximum risk on this position is about $350 for a cash flow or investment of about $350, $400, somewhere in that range. Now, when I looked at this position, I thought, okay, well, that's pretty limited risk right there. I did not feel the need to buy an extra put with this position. It has to do with how I'm selecting stocks here. I'm selecting them a little bit differently than Dan did, yet still conservative as I can be. Most of the stocks I select are going to be low beta stocks and not have a lot of volatility. Because of that, I think we can get our limited risk more easily without having to buy puts. I don't know if Tom, you or anybody has looked at Tilray last week, one of the new marijuana stocks, but in one day it went from between 150 and $310 in one day.
Oh
That's
my
not the
gosh.
stock I'd be doing here.
Wow. That's a movement.
Yeah, I have a friend that actually made money on it, but he was lucky, you know. And the IV on the near term options is over 200%. So we won't be doing stocks like that in the service here. Otherwise, when we have these positions, I plan to, if they go up, we'll just pretty much ride them out. Most of the time, the upward graph is pretty flat all the way. And I like to usually start them about somewhere in this range, as opposed to down here or up here. I like to start about in the middle. MSO is a nice, stable energy stock. It has good dividends if you own it. And all the numbers worked out to make this trade. So as far as lot size goes, I did a one lot here, but I plan to increase to about two lots for each trade. Still going to be planning to do this on a $30,000 account, just like Dan did. But to do that effectively and get 50 or 60% of the capital working, I need to increase the lot size a little bit, or put on 10 trades. And I'm not sure I want to put on 10 trades at a time in the service. Maybe 3 or 4 or 5, something like that. Does all that make sense, Tom?
Yeah, it does.
Okay. Then I don't have any examples to show, but I will do parking trades in this service. And I might do one today. I'm watching. If we keep going down and the VIX keeps going up, I'll probably be opening a parking trade today. Parking trade is something that I invented along with my friend Dave Thomas, I don't know, 5 or 6 years ago. And it can be a very good strategy as long as you don't do it big and try to make it your bread and butter trade. Um, Essentially, it's a far out of the money credit spread on SPX, and has a good profitability percent return in about 30 days of somewhere around 3 or 4%. And we have about a 90% or better win rate on that one. So, but we look for a down day to do it. And today is pretty close to what I'm looking for. I'm kind of wanting to see how all this new tariff news shakes out a little bit, because I guess there were new tariffs or something today.
Yeah, I think the US imposed $200 billion on China, and then China imposed 60 billion on the US.
Yeah. So,
But I saw China's kind of running out of steam though. They've only got like $130 billion of import or exports to or imports from the US. So that's they've already done 120 of their 130. So they kind of ran out of leverage.
I see. Okay. All right. Well, if you remember 2, 3 weeks ago when this latest round was announced, not even done, but announced, I think we had a 16 or 18 point drop in SPX that day.
Yep.
Yeah. So I kind of want to see how this shakes out for a few more hours before I pull the trigger on a parking trade. But I'd probably do a parking trade today, and I'm watching for that. So back to limited risk. When we're doing a covered call, we're trying to sell premium. Let me just bring up Exxon, for example. Exxon's one of the ones that I look at and may be doing at some point. Here's an Exxon options chain, and we'll just go look at 19 October scoop. Um, there's a fair amount of extrinsic value in some of these options here. It'd be nice to sell that premium, and the problem is this is an expensive stock and we can't buy it, and I'm not sure I want to buy puts. And so what I might do sometimes is call credit spreads. So I might sell some of this premium, whichever one I think is best, and buy a long call option out ahead of it to limit the risk there. So if we did that, it would look like a vertical spread. I will give back a little bit of the premium for doing this, but not too much, and limit the risk that way to 3, 4, 5 points. So it'd be $300, $400, $500 for one lot on this one. $300. So that's another strategy that I will use to sell call premium. And then I talked about doing cash secured puts in the service, and I would still like to do that. However, it's the same idea. If you simply sell a put, like maybe let's say we sold this one, you have $1,600 margin just for selling the put, plus you have more risk than that if the stock should tank or go down fast or something. So I may do some cash secured puts like this, trying to keep the margin say under about 2,000 for any one position. But we may also do the same idea as with covered calls. We may buy a cheap put underneath it, which limits the risk if you get close enough. You can see here in this case, we're close enough and it went from $1,600 down to $500. If you go crazy and go really far out, it doesn't matter. You might as well not even do it. It doesn't help. Like there's a put 40 points away, but it keeps the margin, didn't affect the margin. I wouldn't do that. But we would do something like this. Okay, and then flat out put credit spreads sometimes to take advantage of premium there. So I guess those are my plans for the service and what I'd like to do in it. I'd like to get the profitability up higher than doing just one lot each trade, and see if we can make in the hundreds per month on this.
And did you see there were a couple of questions in the chat?
No, I actually didn't see that. Let's see. Do you want to do them for me? I'm not seeing them.
Oh, yeah. I think when you're presenting, you have to go up to the top to that three dots, and then you'll see that there's a chat option. But Robert asked, do dividends actually work against you since it's all options? And then Ralph asked, how are you now picking your parking trade strikes?
Oh, okay. Dividends actually work against you since it's all options. If we're doing the synthetic covered call, there's no dividends involved. You do not collect the dividends, which I usually like to collect when I'm doing covered calls, because dividend amounts to 3, 4, 5% on a lot of these stocks, and that's more income. However, if we're trying to limit our risk so much that we don't spend $7,000, $8,000 on buying the stock, then we're not going to get the dividends. However, at the same time, if your short call is in the money, you do have dividend risk. When it goes ex-dividend, you could actually get assigned and end up having the stock. So we'll be watching for that and trying to prevent it as well. Parking. I haven't changed the way we do parkings. It's not particularly complicated, but let's see if I go to SPX. Let's type it in here. Pretty much parking strategy hasn't changed in a long time. There we go. But if you don't know what it is, we look for a down day when the VIX is up 10% or so, and I see it is up 10% now. While we're talking, it's just gone over 10% rise. And SPX is down 15 points or more, or maybe 10 if I'm feeling bullish. And we look for, there's two ways I do parking, but we look for a strike that's about 30 days to expiration. That would be this one. And then we look at this market maker move, and we start by trying to place our shorts 2 times the market maker move out of the money. That's still the method we're using. And once you get your trade on for 80 cents to $1, more like $1, then we put a good to cancel order in to close it if it closes at $3. And that's a good point. I'll be using good to cancel orders like that often in the service, and I'll be using alerts often. So I'll be saying all that in my messages as well, that we want to be sure and set your alerts.
Oh, and I guess Robert's point was that the dividend value is subtracted from the stock valued at the ex-dividend date.
That's generally true, yes. So if you own the stock and the stock goes down, the call goes less in the money or further out of the money, and but you collect the dividends. So it's generally a wash with the dividends as long as the stock reacts by about the value of the dividend. If we're doing these covered calls, these synthetic covered calls, the dividend is not something I'll be thinking about unless the call's in the money before dividend date, and then I'll be doing something to make sure we don't get assigned. If it goes down, let's say by 50 cents, because there's a $50 dividend, that won't usually by itself generate a roll for me or an adjustment, but it is something to watch. That's true.
Hey, Tim, do you think it would be useful to share your or to show your Excel spreadsheet where you track your covered calls?
Oh, sure. That is this one. This is something I'll be using. I do distribute this, and so I can put it in the document section or something of the service.
Well, if it's something that you update frequently, maybe it's best to use a forum thread for that.
Maybe, or maybe I can just post images of this. That's a good point.
Yeah.
Here is the SO trade that we did last Friday. And I track all my covered calls in here, and I got more than just I have in the service, but all the ones I have in the service, I'll be tracking in here as well. So essentially what you do is you enter the data in only up to here, and then everything over here is calculated, okay? So if it's a campaign style trade like some of these are going to be, you start out with one option, and then sometime just before this expires or after it expires, we'll sell another one against the long one that we bought further out in time. These are campaign type trades. And so this P&L here would steadily increase in that case. And then every time I make an adjustment, I put in exactly what I bought and what I sold, and it always calculates the P&L that I have realized on this trade. So we look at maybe MOs, one of mine. I've done all this work on it. This case, I actually own shares, but you can see how through doing all the options, the total income has increased every time I do something. So this spreadsheet works out really well to track your current status, especially the long-term campaign style trade. And I use it for everything that I do, except my road trips. It doesn't work for that. But yeah, I think I'll be posting images at least on this, and sometime I will try to put a sample of this out so people can use it if they want to.
Okay, great.
So here's SO again.
Do you have like a summary of the performance of how your covered call has been doing over time?
Well, I'll have to put it together. Yeah, we want to post something like that. I'll put it together based on the information in this spreadsheet.
Just off the top of your head, what would you guesstimate?
I would estimate that I'm getting about 15 to 20% a year.
Okay, it's
And
pretty good returns.
that's kind of what I'm looking for in covered calls. It's not a strategy that's going to do 5% a month or anything. No, you're just not going to get that doing covered calls safely. But if you include dividends, probably closer to 20%. If you don't, maybe 15, something like that. Yeah, I have a little bit of work to do to put some history together for you, but I'll try to work on that.
Okay.
Yeah. With shares like AT&T, I've had these shares since long before 2017. I've had them, I don't know, probably 10 years. But my goal in doing covered calls on something that I want to keep forever is to simply try to double the dividend rate. So if AT&T is paying about 5%, I'd like to get it about 10% per year. And it shouldn't be too hard to do that with covered calls. On this number, you can see I do track the dividend. On some of these, I put the dividend in, so we get a $250 dividend every quarter, and that adds up too. But if you took those out, I'm still getting income from just the calls. SPX is recovering a little bit.
Yeah, I see that. It's off the lows a bit, about 4 points.
Yeah. So here, this was SO. Let's just take a look at our positions. So we have Microsoft, which is a position that Dan has started, and I'm trying to finish it for him. If you look at this P&L here, it says it's up $234 since it started, which was on August 16th. That's not bad. What we're seeing here is all trades. Let's just Microsoft. That's not bad for doing this. It might be time to consider maybe just closing this one and going on to a new one. But the graph looks like this right now, according to option view. And we have our expiration coming up October 12th. So when I get in a situation where I've realized a high percentage of the maximum possible, I usually just close these things, take the money, go on to something else. And Dan did well when he started this, and we've done one roll since I started the service, and it's positioned perfectly right now. I mean, there's nothing to do on this one.
Yeah, that was a good one.
Yeah.
Robert had another comment. It says doing a delta value selection of the call or percent of MMM.
Okay, so Robert, I'm not sure about your question. Let's see, delta value selection of the call. If you're talking about the deep in the money
Market maker move.
Yeah, market maker move. If you're talking about how do we select the deep in the money call for a synthetic covered call, then I'm looking at about 80 delta most of the time, and I'm looking at far enough out in time so that we can do several cycles against it in a campaign style trade. I don't want to go too far because the further out you go, the more expensive it gets. But 3 or 4 months generally is a good idea. Maybe 5 or 6, depending on what the volatility of this stock is. Did that answer your question?
He said selection of covered call about market.
So maybe you're talking about the short. Okay, good question. Let's go to Microsoft. That can get more involved, or it can still be easy. It depends on what you want to do. So let's say we wanted to sell a 30-day call on Microsoft here. First I'll look at is what call should we sell? And the first thing I look at is what's the extrinsic value of all these calls. I'm looking for something with maybe around 10% of the value of the stock, sorry, 1% of the value of the stock for a 30-day one to sell. If I'm able to do that and collect all its premium, that's guaranteed about 12% a year. Now, that sounds low. There's things we'll do to increase that, but especially by doing the synthetic, that as a percent of the margin invested turns out to be a bit higher. But I want it to be out of the money reasonably enough, and so I'm looking for premium to start with. And if this is true, here's some really good premium here at the 123, but I have a hard time believing that's true. Something's probably not right with that one, with the quotes right now. But here's some good premium here, 119 on a stock that is 1.2 beta, so it's not extremely low beta, but this might be where I'd start working the trade up to see how it looks. The more involved analysis that I usually do is let's compare the annualized return if we get all the premium of this with one a little further out in time. So this would be $1.32 on essentially a $11,400 investment or so, approximately 11,450. Divide that out and annualize it. Get my calculator out now. So we get $1.32. It's 1.2% in 32 days. If you analyze that the way I do it, which is a good approximation, it's not what they would teach you in business school, but it's a good approximation. That's 13% per year. Okay, so that's that one. If we wanted to look at something further out in time, like 16 November, let's look at this one here. We've got $1.71, 114.51 stock. I think it was 49. Oh, it's 51. It's 1.5%. But if you annualize this, it's 10.1%. So this one actually, although it has higher extrinsic, it actually has lower percent return on an annualized basis because it takes longer to get it, if you realized all of that. So when you do this kind of analysis and you start working up different strikes and different annualized returns, then you can hone in, you can directly compare different choices, and you can hone in on one that has the kind of annualized return you're looking for. I usually do that. I have a little spreadsheet that I use for that. Maybe one day I'll go over that in one of the roundtables. So Robert, that answers your question there. If you look in this list over here on the left of my screen, this is what I call my core watch list, and it's generally, it includes most of the stocks I'll be looking at for covered calls. Not all of them. I have another list somewhere, and of them I do scan, but a number of these I actually own and I'm doing covered calls on now. And you can see SO's in here, D is in here. I need to, for my personal account, I need to trade D again today, but I'm not sure I'll do that in the service. And QCOM has been a good cash secured put stock. I built a watch list of all the ones that I want to consider a look at, and then I can see how they're doing each day. Okay.
Hey, Tim, maybe you could talk about a little bit the things you're looking for in a stock that you want to trade for covered calls.
Oh yes, good point. Well, I'm looking for high capitalization, probably blue chip stocks, not necessarily limited to the Dow, but high capitalization blue chip stocks with a relatively low PE ratio. You know, now Microsoft's at 53. Is that high or low? For the tech industry, I don't know. That's probably maybe about right or low. But generally, if you look at SO, for example, it's got a PE of 18. I'm looking for its PE to not be really out of line high. That's one thing. This is in line with value investors, and so essentially I'm looking for good value. AT&T, if we look at that one, yeah, 6. It's really low. That's pretty low for AT&T. And if you think about, I don't know what the average is for SPX now, but it's probably 17, 18, 19, something like that. I don't want to get much above that. That's one thing. Large capitalization, blue chip stocks with low beta. AT&T fits that bill perfectly. And very important. I don't want a stock that is dependent on one or just two products for most of its revenue stream. Okay. I want a stock that is broad-based, has a large number of products and a large number of markets, and so it'll be a more stable stock. Um, when, let's say, for example, one of its products, there's a lawsuit over something one of its products did, that's only one product out of 50 instead of, as opposed to some other companies where you get it all from one or two products, that's half of their revenue if they have trouble with it. That rules out Apple, by the way, so I won't be doing Apple in the service. And that's an important one. And then I want stocks that pay a decent dividend. I won't do any stocks that don't pay a dividend. Dividends are good to collect if you own the stock, but more than that, they indicate that a stock is more stable and more mature, and they're paying a dividend. And if the dividend is higher than the going interest rate, then it means the stock is probably declined and it's low. So like the going rate's maybe 3.5% right now. AT&T is probably undervalued because it actually has a higher dividend rate than that. Now you have to be careful with that because like some real estate investment trusts have dividend rates in the 10 or 12% range. And some of the stocks are even in that range. But if it gets too far out of line, then something's probably wrong. It's probably unsustainable and they'll be cutting their dividend. I look at there's dividend champions or dividend kings or whatever you hear about out there. Those are good lists of stocks that fit most of the criteria that I like to apply. Got the chat up. Hey Ralph, how you doing? I got the chat up here.
Oh yeah.
Yeah. I learned a lot from Ralph, and we traded together for some long period of time, and so it should sound familiar. All those are good concepts, and they still apply. How about the trend? Okay. I am not a technical analysis person. I don't do hardly any technical analysis at all, period. End of question. But I do a little bit on stocks that I'm doing covered calls on. And this is, let's see, an example. Here's AT&T. It's Many would say it's in an uptrend. I don't know. I don't care if it's an uptrend or not. But what I am looking at are two things on this chart. I like the stochastics, and I like to see if the stochastics are high like they are here, and the fast line is crossing below the slow line, the downside. That's a good indication that maybe you should sell calls somewhere out in the money up in here somewhere. That's one of the things I am looking at when I do this. At the same time, if the stock is touching the upper Bollinger Band, I'm a Bollinger Band guy, read the book, I like Bollinger Bands, then again, it's more likely to go down than up. Now, it often will touch the band and then right up the band, okay, and so then you kind of need the combination of stochastics to help you decide when it might be petering out a little bit. That's just about the extent of any technical analysis I do. And by the way, when I do road trips and other trades, I don't do anything like this on SPX. I just make a trade. Options are much more suitable to be followed by statistics than they are by technical analysis, in my opinion. So that's as far as I go looking at anything like trend or technical analysis. These large blue chip stocks, they stay in a Bollinger Band more than stocks like Tilray do. So if you're trend trading, you might want a more volatile stock that might trend better. But this is what I do. If we go look at SO, SO was when we opened that trade. See what day was it? It wasn't 18th. It was probably about 20th or 21st. No, it's today. Oh, it's probably, well, here. Why not answer that question? I could tell you. Have it written down. 21st. That was Friday that I opened this one. And here was SO on Friday in this range. The stochastics are low and turning up, and it's at the bottom of the Bollinger Band, and it's a stock that I like that's stable. So I decided to do a position on it. And why did I sell calls when it's at the bottom? Because if you remember the SO chart, um, the SO graph, let's see, go back to that. There it is flat to the upside forever. And so it can go up all at once and we'll still make our money on this one. So essentially I was looking at it not going down more than is it going to go up.
And Tim, do you tend to let a stock get called away if the market rallies and you're short like this, or do you sell out the call and roll it, or what's your trade management?
Yeah. In the service, I don't plan to let it get assigned because we want to limit our risk. And let's say I have 5 or 6 trades on that are, say, 2,000 a piece. That's almost half of a planned account value. And if we suddenly had to buy a $7,500 stock, um, I don't know, that's a big hit. So
Yeah.
in the service, I don't think I'm going to let that happen. So what that means is if a stock goes in the money and there's dividend coming or there's no extrinsic value or expiration is coming, it means that we are going to be rolling it or closing it.
So the planned account size is about 10,000?
30.
30? Okay.
I think that's what Dan was using, and I
That's
don't.
what it had been. Yep.
Yeah. Um, right.
And
So
then,
currently, I'm in a period of ramping up the trades, and so I'd like to get a few more trades on in the account, and then we'll go from there. So look to see some trades be opened sometime soon.
and then how about your thoughts on a trade if the stock declines after you put the trade on?
So here's this. So again, if it gets down somewhere in this area, well, first of all, remember the total risk, no matter how low it goes, is about 350, 360. Okay, that's acceptable. That is not an acceptable risk. That's very limited. But if it goes down to maybe here somewhere, we'll probably at least one time do some rolls to reposition this graph to an area of profitability. That's the plan. If I find I have to roll it 2 or 3 times or something, I'm not sure I would keep doing that. It might be time to exit. And I usually will put in my daily planner when I update it, here's when we're going to do something on the downside, and here's where we're going to do something on the upside, if anything. You can kind of see what we're doing. Oh, so we didn't look at, there's one more position we didn't look at. We have CSX open. Dan had that one open, and I'm finishing it. I think we did a roll on this one already. Nope, I didn't roll CSX yet. That's right. Here is, here's what it looks like for the October expiration. You can see it's bullish, and as Dan said, most of these strategies are bullish oriented, or at least not really bearish oriented. I'm happy with this for now. If it starts going down, we may need to reposition or do something on this to improve the picture. Probably be out in here somewhere where we might do that, 72, somewhere around 72. But CSX is a good stock. If we look at it's got a beta a little bit higher than the market. It's got a low dividend yield. and they don't have a dividend coming up for a while yet. So we have some time to work with this one before we decide if it works or not. So TSX, Microsoft, and SO, right? Okay. I won't be doing anything like adding butterflies or um, condors or anything. I won't be doing anything like that in this service. I want to keep it simple and keep it related to covered calls and cash secured puts type trades.
Do you have any rough guidelines of what percentage of the account will be, say, covered calls and versus like parking trades or something else?
That's going to be hard to say because with the parking trade, it's an opportunistic trade. You know, when you get the opportunity, I want to do one. If I don't already have too many of them on. In the service, I think that 2 would be the most parkings I'd ever have on at any one time. More likely 1. You know, when SPX was down 16, I think just before we started, I was very, very close to doing it, but it might have been a good thing to do at that time. But let's wait and see. SPX may yet um, go down some more today. Let's see here. Oh, there. I want to
It's
get my
recovered a bit.
indexes back. So
It's
here
down
it is,
11 right now.
down 11, yeah. And VIX is up 7.2%. I know you can't hardly read that, 7.2%. So I think I'm going to wait a little bit and see what happens. If we don't get it today, there'll be another day. I don't want to be in a hurry to put these on just because I have to. I want to do them when it's opportunistic. So with covered calls, they're also opportunistic, but you can almost always find a good one. So later today, I'll go looking for some more covered call type trades to make. Yeah, some good questions, Tom. Thanks.
Oh, sure. I'm just thinking if I was a subscriber or potential subscriber, what kind of questions would I have?
Yes, right. I'm not getting too many questions.
And then on a typical week, how many trades, either new or adjusting or closing, would you say you're putting on? How
So,
busy is it?
how busy, right? So, like Dan said somewhere in one of his posts, this can be a sleepy strategy or a sleepy service, if you want to call it that. In that most of these take a while to develop; they're not quick trades. So, if I'm not full, meaning if I don't have maybe $15,000 worth of margin employed, then I'll feel like I can put more on. But if I have that much employed or if I have more than 4 or 5 trades on, I'll probably slow down, if you know what I mean, and focus instead on getting some removed before we start getting more new ones. That's my plan. The more trades you have on, the more work it gets to be. It's hard to manage multiple trades, especially when there's a big move. So I want to be careful there. So I'd rather put on, for example, 4 or 5 2-lot trades, or maybe even 3, than 8 or 9 or 10 1-lot trades. You know what I mean? Finish my coffee. So let's see. I would say to everybody, I'm still figuring out just exactly how to run the service. Tom has given me some great tools to use to do it, to send out all my messages, but I'm still figuring it out. Trade messages, I've got that figured out, but how to do updates and images and documents, I'm still working on. So get that figured out pretty soon, and maybe Tom, you can give me a little help once in a while.
Yeah, not a problem.
And let's see. Option view, I'll be tracking the trades in option view. But looking at and I'll post option view images, just like you do in the other services, but I'm also watching these trades in Thinkorswim, and that's my first go-to watch of the trade when I'm looking at them. But if you do use option view, be sure and set it to EIOIO volatility model, because that's closer to Thinkorswim than this variable model. Not too far apart on this one, but it can make a big difference in how the graph looks, and so I'll be using EIOIO.
That's a Bruno said in training group 1, use EIOIO.
Yeah. And, you know, good luck figuring out what that means, but it does mean every individual option on its own. I guess that's just how they named it when they programmed it. So, yeah, I'm going to make a note to post a sample of this spreadsheet.
Again, it might be easiest to put it in the Phil's forum for the service. That's a good place to put stuff like that.
Need a picture of this when I get a fill?
Yeah, just do a screenshot, or you can. Dan always just did an export into a CSV file and just posted that.
Okay, right. Okay. Well, it'd probably be easier for me to use this because this is what I use all the time. So maybe I'll try that. And I'll highlight what the trade was or something.
Yeah, it should be easy enough.
Okay. I would point out to those listening today, the CSX and Microsoft trades. I'm simply monitoring these in option view. These are not trades that I have done in my account because they're in Dan's account. But all new trades that I do, I'm actually doing in my account as well as in the service. So we're all together on that.
Well, looks good, Tim. I don't see there's any other questions. Any other things you want to cover before we wrap it up?
Well, if people want something else, let me know what you'd like me to do, or both in terms of different trades or maybe different risk levels, and in terms of communicating or posting. I'd like to get some feedback as to how it's going.
Well, great. Well, I think if that's it, we no need to keep people here longer than necessary. So thanks for the overview of what you're doing, Tim. I'm sure those blue chip stocks will have nice returns and consistent over time. And the parking trades are a nice addition too.
Yeah, I think that'd be a nice compliment. So, yeah. Okay. Well, thank you.
All right. Thanks, everyone. Thanks, Tim. We will see you later, and I'll get this recording posted as soon as I can.
Okay.
All right. Thanks, everyone.